Happy Thursday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic developments in the world's number 2 economy. My name is Tony. Let's jump in. The US-China trade conflict reached new heights this week as the Trump administration unveiled a fresh probe into critical minerals and clarified that some Chinese goods are now facing cumulative tariffs as high as 245%. Although the figure reflects existing levies rather than new ones, it underscores the intensifying economic standoff between the world's two largest economies. The White House confirmed that the 245% tariff rate applies specifically to electric vehicles and medical syringes. A White House official admitted that figure was, quote, just now added up, end quote, emphasizing that most Chinese exports still face lower, though historically elevated, duties. Upcoming tariff hikes are also scheduled, including a jump to 245% on medical gloves. Meanwhile, President Trump signed an executive order this week to investigate the security implications of critical mineral imports. Under the Trade Expansion Act of 1962, the Commerce Department now has 270 days to determine whether reliance on foreign minerals, especially from China, poses a national security threat. The probe could affect dozens of materials, including rare earth elements, lithium, uranium, and nickel, all essential for defense and high-tech industries. This move comes amid a broad escalation of trade tensions, with China retaliating by halting deliveries of Boeing jets and slapping a 125% tariff on US-made goods. Chinese carriers have been instructed to suspend purchases of US aircraft equipment. Boeing, which previously relied heavily on China's aviation market, now faces a major strategic setback as Beijing pivots toward European rival Airbus. As the trade war intensifies, diplomatic overtures remain stalled. Beijing is demanding a reset in tone and structure before it will engage in negotiations. Chinese officials have privately outlined several conditions for restarting talks: a consistent US position, respectful communication from all cabinet members, and the appointment of a point person with the president's full backing. They also seek US attention to issues surrounding Taiwan and a perceived campaign to suppress China's technological development. It's more than perceived, however. The US has made it clear that its technological supremacy is key to national security, and thus it's a priority to prevent the Chinese from excelling in AI and other advanced technology, especially those with military applications. Despite Trump's repeated calls for China to return to the negotiating table, Beijing appears unwilling to respond until its preconditions are met. Preconditions the US will likely be unwilling to meet, especially around technology and Taiwan. At the same time, Beijing is actively redirecting trade flows. Chinese refiners are now importing record volumes of Canadian crude oil, capitalizing on a new pipeline expansion and significantly slashing purchases of US oil, down nearly 90% from peak levels. The move reflects Beijing's strategy to lessen economic dependence on the US, especially in key sectors like energy and aviation. But Chinese reliance on the US is not down to what it imports from North America, but what it sells to North America. The massive size of the American consumer market is what drives many economies, including the Chinese one. As we will see later in this episode when we look at the trade numbers that were just released yesterday, the only healthy spot of China's economy is exports. Exports which have now lost their key market. The Trump administration argues that the tariffs are in part meant to bolster domestic manufacturing and reduce strategic vulnerabilities. Additional probes into semiconductors and pharmaceutical imports are already underway. We discussed this in yesterday's video, and emergency powers have been invoked to increase financing for domestic mineral production. Financial markets remain volatile as the standoff continues. While both sides say they are open to talks, the path forward is murky. Quote, "There's more clarity now on China's demands, but it's unclear if Washington can meet them," end quote, said Societe Generale economist Michelle Lamb, adding, quote, "Negotiations are unlikely to result in meaningful de-escalation unless both parties move significantly," end quote. As global supply chains strain under the weight of new restrictions and political distrust deepens, the trade war's trajectory increasingly threatens to fracture the global economic order. Whether or not Trump and Xi Jinping can bridge their divides remains a defining question for markets and diplomacy alike. But as we saw in yesterday's video, it could well be that the US is seeking to create a new trade order, one which centers on the might of the American market, and one in which the Chinese are excluded. We are certainly living through history, and the US-China trade/security dispute, this new Cold War, is at the center of it. If you want to continue to be on top of the most up-to-date news and analysis on this turning point in history, consider subscribing to China Update, hit the bell notification icon, and you will be on top of the most up-to-date analysis on this relationship, as well as China news generally. This channel seeks to be the most informative source on China on YouTube, and I hope you can be part of our journey. If you're getting some value from today's episode, don't forget to hit the like button. And if you are interested in the trade reset generally, this is an area we are following very closely on my other channel, Market Update. I've put a link to today's episode, which has just gone out about an hour ago, in the description and the comments section below. Hit this link and you can follow our coverage over on Market Update too. Okay, let's continue. Next up, we move to the Chinese economy. China's economy beat expectations in the first quarter of 2025, with the GDP expanding 5.4% from a year earlier, surpassing the forecast of 5.2%. Although, like all things, the devil is very much in the details. The unexpected strength was driven by a rush of exports ahead of new US tariffs and government subsidies, bolstering consumer spending. However, mounting trade tensions with the United States are clouding the outlook, raising pressure on Beijing to deploy more aggressive stimulus measures. Industrial output surged 7.7% in March, the fastest pace since mid-2021, while retail sales jumped 5.9%, well above economists' estimates. The National Bureau of Statistics said in a statement that while the economy had started strongly, quote, the external environment is becoming more complex and severe, and the drive for growth of effective domestic demand is insufficient, end quote. It emphasized the need for, quote, more proactive and effective macro policies, end quote. Economists warn that much of the first quarter momentum may have already faded. Quote, the improvement is all in the past now, end quote, said Michelle Lamb, who we quoted in the first half of today's video, adding, quote, stimulus delivery is still pretty urgent. Things can deteriorate fairly quickly, with some high-frequency data showing tariff impact on US-bound shipments, end quote. Indeed, early trade figures from April signal a slowdown. Port cargo volumes have declined, and Chinese equities in Hong Kong dropped as much as 3.3% on Wednesday. The yuan remained steady in offshore markets, while yields on 10-year government bonds eased, suggesting investor concern. The economy's strong start was partly thanks to front-loaded exports. Quote, we expect policymakers to step up stimulus urgency, front-loading this year's big budget and cutting rates and reserve requirements, end quote, said Chang Shu and David Chu of Bloomberg Economics. Government subsidies also played a key role. Programs to provide the trade-in of cars, appliances and smartphones drove a surge in retail categories, with sales of home goods up roughly 30% year-on-year in March. Still, sectors without subsidies, such as cosmetics and apparel, saw only modest growth, suggesting fragile consumer confidence and consumption that is being driven by government subsidies fueled by debt. To support the shift from goods to services, Beijing unveiled 48 new measures aimed at bolstering spending in catering, healthcare, tourism and entertainment. Catering saw the fastest growth in a year, supported by dining vouchers issued by local governments. Yet deflation remains a concern. China's GDP deflator fell for the 8th straight month, the longest decline since records began in 1993. Meanwhile, fixed asset investment rose 4.2%, in line with expectations, but real estate investment fell 9.9%, underscoring the sector's persistent weakness. Premier Li Qiang on Tuesday underscored the importance of domestic demand during a visit to a consumer expo in the capital. He urged firms to, quote, diversify markets, end quote, and pledged to, quote, study and launch new supportive policies in a timely manner, end quote, particularly to absorb unsold housing stock. Quote, China can only count on domestic consumption, end quote, said Raymond Young, chief economist for Greater China at ANZ Bank, adding, quote, the retail sales figure is encouraging. Whether it can be sustainable depends on how fast and large the stimulus package will be, end quote. With the Politburo set to meet later this month, markets are watching closely for signs of Beijing's next move. The risk, analysts warn, is that leaders could delay action until the economy hits a wall. We end today's part and today's video with some observations made by our go-to voice on China financial and economic analysis, that is Peking University Professor of Finance Michael Pettis. He observed today, quote, China's GDP growth for the first quarter of 2025 came in above expectations on a year-on-year basis. and below expectations on a quarter-on-quarter basis, which shows how hard it is to reconcile the two. At 5.4% year-on-year compared to 5.3% in 2024, economic activity in the first quarter of 2025 was disproportionately driven by a surge in exports. On a quarter-on-quarter basis, GDP growth was only 1.2%, below expectations and well below last year's 1.5%. Much of the growth occurred in March. Retail sales and industrial production both grew much faster than expected, with the former rising 5.9% year-on-year compared to 4% in the first 2 months, and the latter rising 7.7% compared with 5.9% in the first 2 months. Retail sales seems to have been driven by an expansion in the consumer voucher program, which suggests a lot more needs to be done simply to limit the worryingly wide gap with industrial production. What China needs is not just for consumption to grow, but rather for consumption to grow relative to production, and this seems to be very hard to achieve. In that light, the most interesting part of today's data released, for me, was the extremely high growth in manufacturing investment, 9.1% year-on-year in the first 3 months. This suggests the economy is continuing to rely heavily on an expansion in manufacturing to achieve the growth target, but without an equivalent rise in consumption, which seems extremely unlikely. Much of this must show up as a widening of the manufacturing trade surplus. This was already reflected in the trade data released last week. While exports in March were up sharply by 12.4% year-on-year in USD terms, imports were actually down a very worrying 4.3%. Clearly, Chinese consumption continues to struggle this year after a very poor 2024. It is hard to read too much into the first quarter data because it is a pretty safe bet that for the US, China, the EU, and most other countries, the rest of 2025 won't look much like the first 3 months. But so far, Chinese imbalances do not appear to be improving. End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Make sure you're subscribed so you're on top of the most up-to-date news as it's released here. Thank you for watching. Have a great Thursday. For those who celebrate it, have a good Easter tomorrow, and I will see you tomorrow.